Good morning, investors. It's 8/20/2020 at 11:20 a.m. I hope everyone's doing good in this market. It is going to be a little volatile coming up in the specifically for the election year. And the last couple months or the next couple months, we should be seeing a lot of volatility. But I want to kind of get into this episode and show you a couple of ways to make money on the downside and also how to protect your assets or the stocks that you may own. Now, I do teach a lot on stock options, so if you already know, let's just back up for a little bit, and I'm going to say that every one option contract is equivalent to 100 shares. So you're pretty much leveraging the same position of 100 shares of something for less capital in one option contract. One of the best ways that I can literally just tell you how I make money on the downside is selling put options. And this is also on a bull market too, or what we call, or in a market that does go up, what we call the bull market. But these put options will help you when you get into covering basically putting insurance on your stocks. So if you have 100 shares, you can buy an option contract on the put side. And if that strike price is met, you get to basically, if you buy that option contract, you get to let go of your shares at that strike price that you bought the option contract at, if that makes sense. And I'll go a little bit more into that. But first, I just want to basically read this to you. This is from my website, my blog, investingwithchris.com. And you can find this over at the put options article. And I'm just going to basically read this to you, go over this, explain a couple things, and then we'll go from there. So basically, you've been asked yourself, what are put options in the stock market, or how do options work? A put option is an option contract in which the holder or the buyer has the right but not the obligation to sell a specified quantity of a security at a specified price, which what we call is the strike price, within a fixed period of time until its expiration. So remember, options contracts, they do expire, whereas if you buy shares outright, they basically never expire until you get rid of them, or if worst case scenario, that bank goes or that company goes bankrupt. So in contrast, the writer of the put option has the obligation to purchase the underlying security if the option is exercised by the buyer, if it is exercised by that put option buyer. This typically happens if the stock price is at the money, what we call ATM, or in the money, sometimes you'll see ITM. The writer is paid a premium for the associated risk on possibly taking on that obligation. So it's almost like an insurance company. You have the insurance company, right, that pays out the claim if there is one made. And then you have us, or what's commonly known as the vehicle owners, that purchase vehicle insurance. And every month we obviously pay a premium. Now, I'm going to get into some examples and some scenarios for you why these put options would work. So if you write or sell put options, or one put option on Amazon for $600 at the $17.76 strike price, and Amazon is currently trading at $18.90, the full $600 is paid to you as the writer. So that money is taken in, it's given to you. Now what you do with it, this is where you either get the full $600, buy it back cheaper, and make the profit on the difference. If you sell it for $600 and get to buy it back for $400, then obviously that's a $200 profit. Or you can actually, unfortunately, if it goes in the direction, you can buy it back for more and get out of that before you have to take over the Amazon shares. If the stock does not drop before or at expiration to the $17.76, you keep the full $600 profit. If the stock drops and the buyer chooses to exercise the put option, then you are assigned 100 shares at $17.76. But remember, we have to take out or take off the $600 to which we already took in, which lowers our break even that was paid to you. Okay, so there's the formula. 100 times 1776 equals the 177,600 minus the 600, which gives us an even 100,077. That's our now break even, which would be the 1770, if that makes sense. So, how do put options work? As we understand what a put option is and what are put options in the stock market, we will know why buying put options and how put options fully function in terms of traders or investor needs. As an option seller, you have the obligation to purchase the shares if the put options buyer has exercised their contract or contracts. And obviously, I have to go in and make some revisions to this. But let's say this. If you're already interested in buying at least 100 shares of a certain stock, XYZ, why wouldn't you just sell a put option against that on a lower strike price? So if you're looking at XYZ stock and it's currently trading at 20 per se, why wouldn't you sell premium or sell one contract at 18 and make some money? And if it drops down to 18, okay, cool, you get to now take it over at 18 versus 20 and you made money. There is an ebook on my website that I am selling that goes over all this. You probably want to pick it up. It gives a lot of information. And I also am giving Treat Your Stocks Like Real Estate ebook. That's got a lot of good information when you already do own the shares and what to do with it on the flip side. So I have 2 ebooks. You can pick them up if you want to. There's a lot of tons of information. There's tons of information in there, basically how to get into selling put options and then how to sell covered calls. The put options is going to teach you a lot of things, when to get in and when to get out, and then also treat your stocks like real estate, when to get in, how to read implied volatility, etc., etc. So I highly suggest you pick those books up. They're found on my website, investingwithchris.com. So let me go on. Now, why would you buy put options? We already found out how to sell put options, but why are you going to buy a put option? The put options example here is if you own 100 shares of Under Armour and think that the stock will drop after their earnings report, you would purchase one put option, depending on the price to which you bought the 100 shares or the price you are willing to sell or let go of your shares. You would purchase that put option at that strike price. This allows you to sell those 100 shares at the contracted price that you bought the put option for. So for example, if you bought 100 shares at 32 times 100 is a full $3,200 that which you paid. And the current price is now at 34. You could buy a put option at 33, and this would allow you to sell your shares at 33 even if the stock drops to 16. So basically you're taking a put option contract, you're purchasing insurance on it, but it's saying that you still have the right to sell that at 33 even if it drops down to 16. I hope that makes sense. And as always, if it doesn't, reach out to me. So, as I said, buying put options is just like insurance on an asset. If the stock drops, you have the right to sell the stock at the strike to which that option you bought. And the seller of the put option has the obligation to buy those shares for the strike price. Or you can sell the contract for a higher price than you originally paid and keep your shares. So here's what a long put looks like. You have a profit and loss. Anything below that, and then anything over, is a stock price at expiration. So let's go over a couple scenarios. You own a $40,000 vehicle. You go and buy an annual insurance policy. The vehicle is neither damaged or stolen, and the insurance seller, which would be the put option seller, has just collected your premium without any payouts. You're happy to have just paid insurance for protection on your asset or vehicle, which is you as a put option buyer. Scenario 2. You're involved in an accident requiring $10,000 in repairs. You make a claim, exercise your put option, and the insurance pays you for the claim. You're happy you purchased protection for the loss or damage. And then scenario 3, you have total loss claim, or the vehicle gets stolen, and again you exercise your put option or insurance claim. You get to have the full amount of your asset or vehicle at the $40,000 coverage. The put option seller pays you the full amount, or in stock market scenario, they take ownership of your shares. And similar like what an insurance company does, if it's deemed a total loss, they take ownership of your car and then give you a check for it. Okay, so we have short puts and long puts, and what they look like. It's just basically a flip side of things. The short put, you're going to make money if the stock goes up, and you get to keep that. And then on a long put, you get to sell your stock if you have any. If you're just a naked long put buyer, then you're out that money if it goes up. But if it crashes down, you make money on getting to sell that contract back to the market for more. Okay, so when to buy put options. As you can see, the benefits of buying put options allows you to lower your losses on a down market when you own shares. So there's one way or two ways how to make money in a down market. You can buy or sell put options. And I've already explained you want to sell put options specifically when you're wanting or if you're already interested in a stock. Now I'm going to show you a PowerPoint presentation that I created on a good strategy when owning or getting into Amazon. It is a little bit more expensive, but I'm going to show you the examples when it comes to selling put options on Amazon. So Amazon is selling naked puts versus verticals. Now I don't want to confuse you when I get to say when I get into talking about verticals, but it's going to make sense here in this term, or sorry, in this presentation. Now the terms, okay. Short naked put. A short naked put is a bullish strategy that is executed by simply selling a put option strategy. This strategy typically needs a larger account depending on the stock's price. Overall, it's used to capture cash flow while being interested in obtaining, again, at least 100 shares of that stock that one might be interested in. The stock is only assigned if the stock price shorted is at the money by expiration. So the stock has to drop down to that strike price to which you sold that option contract for it to even be at risk. So a short put vertical spread. A short put vertical spread is a bullish defined risk strategy made up of a long and short put at different strikes in the same expiration. This defined risk not only helps smaller accounts but also allows them to know their maximum profit and or loss. Okay, so basically what a vertical spread is, you're selling a short and then right away you're buying it back at another strike price. That's all it is. You're defining your risk and you're defining your profitability. So the naked put example, I'm going to go over this. This was back in February 2019, and I gave you the specific time. A naked put, if Amazon is trading at 16.30 and John is not willing to buy Amazon at 16.30, but he is wanting or willing to buy 100 shares at 15.45, while John waits for the price of Amazon to come down, he can capture premium in the meantime until the price reaches 15.45, where he then would be assigned 100 shares at the 15.45 plus the premium collected or the less premium collected. So another example could be similar to car insurance, and I explain this again. Companies collecting premium until they have to pay for a total car and obtain the vehicle. So the probability of expiring out of the money is 70%. The premium collected was $2,165 for the March 22, 2019 contract. This gave us 36 days until expiration, and the current IV was 31%. So what happens is the 1545 times 100 minus the 2165 is the cost of capital if assigned, which would have been 152,335, and break even was 1523 and 35 cents. So the strike price at 1523. So investment gain was 2,165. I gave the return on investment was only a 1.42%, and then annualized ROI, if done over and over, and we in this same scenario happened, the annualized would actually be 15.16%. So that's a pretty good return on $150,000. So if we do that over and over again, we could actually net 15% for the year. And this is just a couple of examples. I don't want you to go out and start trying to sell Amazon puts, but in a bullish market or even a little in a bearish market, I would say definitely look at selling puts, because if you're already wanting to buy a stock, why would you just go ahead and buy something when you can make money on it first? And then if it drops down to that price, you get to collect it, because nothing ever says you buy a stock today and tomorrow it's going to go up. It could go down. So take an opportunity on selling some puts. Go do it on your simulation trading. Go do it on whatever. But I would definitely, I can't recommend, but I would definitely say look at put options. So here's what it looks like. Selling an Amazon 100, TD Ameritrade gives you a break even, and we see this at 15.23.35. The max profit is at 21.65, and the max loss, it's not really a loss. You're gaining ownership It's just going to cost you this much, unless you don't want to cover it with obtaining shares. And when we say cover, it means getting an asset, which is getting the shares in return. You could just close that out, but you would take a loss. I'd rather get a physical asset than just take a loss, because at least you have 100 shares of this, and now you can actually resort to that covered call buying or covered call selling that I wrote the ebook on, and that strategy exists. So when you have 100 shares of something, now you're writing covered calls against it, and that's a whole nother lesson, whole nother topic. But it's just on the flip side. Now you let go of your stock if it goes up to that price, and in return you're still making money on it. So it's almost like renting out your Airbnb, whatever, and if the market goes up, you let go of your house at that said price or that contractor price. So again, here's a naked put visual analysis. The TD Ameritrade Thinkorswim platform does give you the capability to see your profitability or your loss, depending on what strike price at which day, etc., etc. So one more time, short put vertical spread example. For smaller accounts, you can see that the previous example was needing at least $154,000 to cover the cost of the shares to be purchased if assigned. Using a credit spread, we can short one strike price and immediately buy back a put option at another lower strike price, defining, this is going to basically define our profit and loss. The defined risk is the difference of strikes minus the credit received. So let's take the same strike, 1545, and short it with a purchase with the 1540. Define risk with possible max loss of $435. And this is credit minus the difference of strike prices equals our max loss. And as we can see, it's 1540 and 1545. So profitability of expiring out of the money is 70%. And this is a good thing also with options. You have statistics that give you the probability of success. Now, they're not always right on the money, or they're always not 100% correct, but it does give you a statistical, basically, prediction of what you're looking at. It has a probability of expiring out of the money at 70%, and this is also found on the TD Ameritrade Thinkorswim platform. Premium collected is $65 at the same contract, 22 March 2019, 36 days until expiration, and now the max loss is $435. So we take the difference here, and that gives us $500, and that's the difference between the two strikes. So we're gaining $65, and we're risking $435. This is defining your risk and defining your profitability. You don't have the shares that you're going to take over, because obviously it's way less, $154,000. But you're giving up the loss of $435 if it basically works against you. Risking to make 15% with less cost of capital, but will not have shares or assets to hold. Imagine if you only had $2,500 to invest with. You're using only 18% of your entire portfolio to make 15% returns every 36 days. Now, this is kind of high. This is using 18% of your entire portfolio on one position. I don't recommend this unless you're an advanced trader or investor. I usually say 10%. Don't risk more than 10% of your entire portfolio on one position. And here's the short put vertical spread, what it would look like on your Thinkorswim platform. We're selling one vertical spread, but then we're buying back, and it gives us that difference, 65 and 35. And the break-even stock price is at $15.44. So if anything goes over or under that depends, or that's going to give your max profit or max loss. So real quick, to wrap this up, I basically want to say, remember theta, okay? I mentioned this numerous times in articles and videos that the theta curve is around 30 to 45 days to expiration, and this is why. The theta curve really kicks in and it drops off around the 45 and 35 day period. This is where you can either buy or sell options back for a profit a lot quicker. So if we're selling 120 days out, yeah, you're going to get more premium, but it's going to take longer for that theta to kick in. So my sweet spot is 45, 30 days of expiration. So if I short something at 600, and within 10 days of this yield curve, more than likely, I can pick up 10, 20% of that and get out of the position. if I make 10 to 20, the goal is always to make 50% of the targeted total profit. So if I'm shorting this for 600, I want to be out for sure at 300. And I can buy that back for 300, and I just made $300 in profit. And then bam, move on to the next option or the next contract. So I hope this helped. This is how you can make money on the downside of the market. You know, a lot of people that aren't familiar with stocks or even options, they say, well, you can't make money in the stock market if it's going down. Well, that's total BS. I just showed you. There's ways out there. It does take a little bit of practice and skill to be able to understand when to get into these, because you're not always going to be selling options, and you're not always, definitely not going to be selling puts. But if you are interested in buying XYZ stock, make sure you're looking at selling puts. Sometimes it's not worth it because the premiums are just not there. For example, I'm going to show you what these look like on Tesla. Okay, I'm 29 days out, just one day before the 30-day sweet spot. And over here in the top right-hand corner, you're going to see 83.21% plus or minus. That means Tesla stock could go up $384 or points, and it has an 83% chance of doing that. The secret sauce, even more, is I like to sell around 10 or 20 delta. And then I'm going to look at my 83% and see if that's around the 385, because I already know that it has a pretty high chance of going plus or minus. When we look at our deltas, this is correlates, and this is known to flow with your probability of being in the money. So it has a 7% chance of actually dropping down to 1420. Has an 83% chance for sure to go plus or minus 300. That gives us around 2400, a little less. And then down here, if we go on the flip side, downside, this is on puts, this is calls, and this is puts. If I'm selling a put at 1440, well, 400 points, for example, this is 500, or 15, sorry, 15. So it's actually lower, so that's a pretty good chance, because even right here, our delta says 7%, that I can pick up 1735. Now, if I short that for $1,700 for 30 days, I'm risking to have to buy this for $144,000. But I'm making 1%. And if you have that, if you have a high dollar account and portfolio, that's a pretty good return if you do this over and over again. Some financial advisors, that's what they resort to, is selling puts, buying VIX, buying volatility. Basically, you're paying them to not lose you money. Whereas when you manage your own portfolio, you're not spending or giving up 2 or 3%. You're making all the profits, and this is a good way to do it. I'm not saying go right out and start selling Tesla, because we'd have to look at the graphs, we'd have to look at the financials and understand where we think that Tesla will be in the next 30 days for sure when getting into this position. Make sure it's going to be over that. It could be a long-term position. And I'll just keep doing this. If I see Tesla's financials doing really well, and they have more income than debt, and more income than basically assets versus liabilities, then I know that Tesla probably is on track to go ahead and just keep going up. So I might even look at a 45-day if it exists, 43 days, and at the same strike, we can now make double 1440 for 3180, or go a little bit higher. 76% drop plus or minus 432. If I want to get a little bit more risky, I make 5,000. The 20 deltas, we have 66. So for example, we have 6690. Let's just do 7,000 divided by 144,000. Well, actually, I got to do 160. Sorry. Let's just do that. And we now make 4%. 4% annualized, right? 4% annualized. It's pretty good. Or not 4% annualized, 4% every 43 days. That's pretty good. So you're making almost 6,000, or what did I say this was? Where are we at? 6,000, 7,000 every 43 days on $166,000 of risk. And then on the flip side, we just resort to covered call buying or covered call selling if we get assigned. And right here, premium's pretty high. We can sell this thing for $16,000, $20,000. But if it drops, then obviously we'd have to basically look at do our formulas, do our math, and figure out what we can risk and make and give up our stock. So I hope this lesson helped. I hope this video brought some insight on how to make money on a bullish and bearish market specifically, and if you have 100 shares, how to basically cover those assets with insurance. So as always, reach out if you have any questions, and comment down below on what you would like to see in the next video. And until then, happy trading, and see you next time.